You're lying in bed, phone inches from your face, scrolling through home listings you probably shouldn't be looking at this late. Another house pops up, $495,000. You tap it anyway. The photos load slowly, and what you see doesn't make sense. Outdated kitchen, worn carpet, cramped rooms that feel smaller than your apartment, and yet it's labeled a starter home. You pause for a second, doing the math in your head. Your salary, your savings, your expenses. Something feels off. You start wondering if you're missing something everyone else seems to understand. How are people actually buying these places without losing their minds? And then the doubt creeps in. Maybe you're behind. Maybe you didn't make the right career choices. Maybe this is just what adulthood costs now. But here's the truth no one is saying out loud. It's not you, it's the math. And the math is completely broken. You haven't failed. You're just finally seeing the numbers clearly. And once you see them, it's impossible to unsee what they actually mean. The numbers don't stretch, they don't bend, and they certainly don't care about what you want your life to look like right now or what you've been. That's where the illusion begins to take shape, and it's a powerful one, because everywhere you look, the message sounds reassuring. You're pre-approved. The lender says you qualify. The numbers work on paper. And suddenly, a $500,000 house doesn't feel impossible anymore. It feels within reach. But there's a quiet shift happening in that moment, one that most people don't notice. The conversation moves from what you can truly afford to what someone is willing to lend you, and those are not the same thing, no matter how confidently they're presented. Banks don't measure comfort, they measure risk. Their job isn't to make sure you sleep peacefully at night or have money left over for emergencies. Their job is to ensure you can technically make the payments often enough to keep the system running. That's a very different standard than building a stable, enjoyable life. And yet, culturally, we've started to treat approval as validation. If the bank says yes, it must be safe. If others are doing it, it must be normal. Stretching your finances has quietly become a badge of adulthood, something people accept without questioning too deeply. This is where the tension builds. On one side, there's the belief that if you've been approved, you're ready. On the other, there's the reality of what your daily life will actually feel like once the payments begin. The hidden truth is simple but uncomfortable. Just because you can get approved for a house doesn't mean you can live in it comfortably. And that gap between approval and reality is where most financial stress begins, long before the first payment is even made. Now, let's step out of feelings for a moment and look at something far less forgiving: the numbers. Because this is where the story starts to crack. The median household income in the United States sits somewhere around $80,000 to $85,000 a year. That's not struggling. That's considered normal. That's what millions of families are working with. Now place that next to a $500,000 house. Not a luxury mansion, not beachfront property, just a standard house in a decent area. What you're really looking at is a price that's roughly 6 times the average annual income. 6 times. And if that doesn't immediately feel off, it should. Because historically, that number used to sit much lower. For decades, homes typically cost around 2 to 3 times a household's income. That ratio made things manageable. It created space to breathe, to save, to live without constantly calculating every dollar. But today, that relationship has stretched beyond recognition. What used to be considered a comfortable purchase has quietly transformed into something far more extreme, and yet it's still being labeled as normal. That's the part that creates confusion. You're being shown an ordinary house with an extraordinary price tag and expected to treat it like nothing has changed. This is where the contrast becomes impossible to ignore. The income hasn't kept pace, but the expectations have. So people keep trying to fit into a system that no longer aligns with reality, wondering why it feels so tight, so heavy, so unsustainable. And then you hit the first real barrier, the one that quietly eliminates most people before they even get started: the down payment. On a $500,000 house, the traditional advice is simple: put down 20%. That sounds reasonable until you translate it into an actual number. That's $100,000 in cash, not invested, not borrowed, not theoretical. Cash, sitting in an account ready to be transferred. Now pause and compare that to reality. The average person isn't sitting on 6 figures in savings. In fact, most households have a fraction of that. So what you're really looking at isn't a small gap, it's a massive distance between where you are and where you're expected to be. So naturally, the next thought is, I'll just save for it. But when you run that forward, the timeline becomes uncomfortable. Even if you're disciplined, even if you manage to set aside a meaningful portion of your income every year, you're still looking at years, sometimes over a decade, just to reach that number. And that's assuming life doesn't interrupt, which it always does. This is where the alternatives start to appear. 5% down. 10% down. Suddenly, the door feels open again, but that door comes with conditions most people don't fully understand.
Smaller down payments don't remove the burden, they shift it. Higher monthly costs, added insurance, more pressure every single month. So instead of solving the problem, it quietly transforms it into something ongoing, something that follows you long after the keys are in your hand. This is where things start to feel real. Because now, we're no longer talking about big abstract numbers like home prices or down payments. Now we're talking about what leaves your bank account every single month, whether you like it or not. And this is the part almost nobody walks you through clearly. Start with the mortgage itself. On a $500,000 house, even after putting something down, you're likely financing around $450,000. At today's interest rates, that alone puts your monthly payments somewhere in the high 2000s. Let's call it roughly $2,700 to $2,900 just for principal and interest. That's the number most people stop at, and it already feels heavy. But that's not the full picture, not even close. Now layer in property taxes. Depending on where you live, that can easily add another $400 to $600 per month. Then comes homeowners insurance, which has been quietly rising year after year. That's another $250 to $350. Still manageable on its own, but we're stacking now. And then there's maintenance, the expense that doesn't show up until something breaks, which it will. A simple rule is about 1% of the home's value annually. On a $500,000 house, that's roughly $400 a month set aside just to keep things from falling apart. If your down payment was less than 20%, there's PMI, another $200 to $400, quietly added to your monthly obligation. Protecting the bank, not you. Now pause and add it all together. The mortgage, the taxes, the insurance, the maintenance, the PMI. You're not looking at $2,800 anymore. You're staring at something closer to $4,000, sometimes even higher. And this is the number almost nobody leads with. This is the number hidden behind the excitement, the approvals, the listings, because once you see it clearly, the conversation changes completely. Now that you've seen the real monthly cost, the question shifts from, can I buy this, to something far more honest. What kind of income would make this actually feel comfortable? This is where the math becomes unavoidable. Financial guidelines have been around for decades, and while they're not perfect, they give us a useful baseline. The common recommendation is that housing should take up no more than 28% of your gross monthly income. That's the level where you still have breathing room, where life doesn't feel like a constant balancing act. So if your monthly housing cost is sitting around $4,000, that 28% rule implies an annual income close to $180,000 to $190,000 a year. Let that settle in for a second. That's what it takes for this to feel stable. Not luxurious, just manageable. Even if you stretch to the more aggressive threshold banks often use, around 43% of your income, you're still looking at needing roughly $140,000 to $160,000 a year. And that's not comfort. That's tolerance. That's living closer to the edge. And now compare that to reality. Only a relatively small percentage of households actually earn at that level, which means the pool of people who can truly afford a $500,000 house without strain is far smaller than it appears. And that's the moment where everything clicks. It's not that homes are slightly expensive, it's that the entire equation has drifted out of reach for most people, even those doing everything right. Now let's take this out of theory and put it into a life that feels real. Imagine a couple, both working, both responsible, doing everything they were told would lead to stability. Together they earn around $160,000 a year. On paper, they're doing well. This is the kind of household people point to and say, see, that's who these homes are for. After taxes, retirement contributions, and basic deductions, they're bringing home somewhere around $9,000 to $10,000 a month. That sounds like more than enough. It sounds comfortable, maybe even a little secure. Now the house enters the picture. That $4,000 monthly housing cost we just walked through, it's locked in. Non-negotiable. It leaves them with roughly $5,500 for everything else. And this is where the illusion starts to fade. 2 car payments because both need to work. That's easily $700 to $900. Insurance, another couple hundred. Gas, groceries, utilities, phone bills, internet, health insurance. None of these are extravagant, they're just normal life. Slowly, that remaining number starts shrinking. What looked like $5,500 becomes $3,500, then $2,500, then closer to $1,500. And that's before anything goes wrong. There's no room for surprises in this version of life. No space for error. A medical bill, a car repair, a broken appliance, each one isn't an inconvenience, it's a disruption. Something has to be postponed, reduced, or ignored to absorb the hit.
They have the house, the jobs, the structure that signals success. But inside that life, there's tension, constant calculation, quiet trade-offs that nobody talks about. They're not living recklessly, they're living tightly. And over time, that tightness turns into stress, the kind that builds slowly and shows up in places you didn't expect, not because they failed, but because the definition of comfortable quietly changed without anyone really noticing. And this is the part that rarely shows up in spreadsheets, the part you only understand once you're living inside it. Being house poor isn't just about numbers, it's about how your life starts to feel on a random Tuesday afternoon when something small goes wrong. It's checking your bank balance before you say yes to something simple like dinner out or a weekend plan. It's hesitating over everyday decisions because every dollar already has a job and there's no margin left to absorb anything unexpected. You start calculating constantly, even when you don't want to. Then the surprises arrive, because they always do. A repair, a bill, a sudden expense you didn't plan for. And instead of handling it calmly, it turns into a moment of pressure. Do you delay it? Put it on a credit card, or cut something else that mattered to you? Over time, those moments stack up. What used to feel like freedom starts to feel like obligation. The house that was supposed to represent progress begins to feel like something you have to serve, not something that supports you. And the hardest part is how normal it starts to seem. You tell yourself this is just part of the process, that everyone feels this way, that it will get better eventually. But underneath that, there's a quiet tension that never fully disappears. The sense that one wrong turn, one unexpected cost could shift everything. And once you step back and look at it from a wider angle, a different picture starts to form. This isn't just a series of unfortunate outcomes or bad individual decisions. There's a structure underneath all of this, quietly guiding you toward the same endpoint. Banks make money by lending, not by protecting your peace of mind. The larger the loan, the longer the term, the more interest you pay over time. From their perspective, approving you at the upper edge of what you can handle isn't reckless, it's efficient. As long as you can keep up most of the time, the system works exactly as intended. Real estate agents operate in a similar way. Their income is tied to the transaction, not your long-term comfort. A higher purchase price means a higher commission. Encouraging you to stretch isn't framed as pressure, it's framed as opportunity. This is just what the market is now. And after hearing that enough times, it starts to sound reasonable. Even the broader market reinforces the same behavior. Rising prices normalize higher spending. Buyers look at other buyers and assume it must be manageable because everyone else is doing it. The pressure builds quietly, socially, financially, psychologically. And here's the part most people never hear clearly. Nobody in this system is rewarded when you step back and say, this doesn't work for me. There's no commission, no interest, no transaction attached to that decision. So the system keeps nudging you forward toward the edge of what you can carry, because that's where it benefits the most. At some point, all of this leads to a conclusion that most people instinctively resist, not because it's complicated, but because it challenges something deeply ingrained. For the majority of households, somewhere in the range of 70 to 80%, a $500,000 home simply isn't affordable in any sustainable way. Not comfortably, not safely, not without taking on a level of risk that quietly reshapes your entire life. And that realization can feel heavy at first. It can feel like you've fallen behind, like you're missing something others have figured out. But that interpretation isn't accurate. This isn't a reflection of your discipline, your intelligence, or your work ethic. It's the result of a system where the numbers no longer align with reality. The expectations stayed the same, but the foundation underneath them shifted. Prices climbed faster than incomes, and the gap was filled with assumptions, pressure, and optimism that doesn't hold up under scrutiny. So if you're looking at those listings and feeling like you're on the outside, understand what that really means. It doesn't mean you're failing. It means you're seeing the situation clearly enough to question it. And that clarity, uncomfortable as it may be, is actually where better decisions begin.
Once you step out of that pressure loop, something interesting happens. The decision stops being about keeping up and starts becoming about what actually works for your life. And from that place, more options begin to appear. Options that were always there but felt invisible when you believed there was only one right path. Maybe it means continuing to rent, but doing it intentionally, not as a failure, but as a strategic choice that gives you flexibility and the ability to invest consistently. Instead of tying everything into one asset, you build stability in quieter, less stressful ways. Maybe it means adjusting the price point, looking at homes that don't stretch you to the edge, even if they're smaller, farther out, or less ideal on paper, because what you gain in return isn't just affordability, it's breathing room. For some, it might mean changing locations entirely, exploring markets where the same money creates a completely different reality. And for others, it's simply about timing, choosing to wait instead of forcing a decision in a market that doesn't make sense. The key shift here is simple but powerful. Success stops being defined by ownership at any cost and starts being defined by control, sustainability, and the ability to live without constant financial pressure shaping every choice you make. At some point, you have to step back and ask a deeper question, one that goes beyond numbers and approvals and expectations. What does wealth actually feel like in your day-to-day life? Because somewhere along the way, we started equating wealth with ownership, as if having your name on a property automatically meant you had made it. But real wealth doesn't show up as a title deed. It shows up in how you move through your life. It's the ability to handle an unexpected expense without panic. It's having space in your budget, not just obligations. It's the quiet confidence that you're not one bad month away from everything tightening around you. When ownership comes at the cost of that stability, it stops being a symbol of progress and starts becoming a trade-off. You might technically own the house, but your time, your energy, and your choices are tied to maintaining it. That's not freedom. That's pressure with a different label. So the definition has to shift. Wealth isn't about stretching yourself to reach something that looks impressive from the outside. It's about building a life that feels sustainable from the inside. And sometimes the most powerful financial decision you can make isn't saying yes to ownership. It's choosing the kind of freedom that actually lets you live. So let's make this simple, even if it's uncomfortable. If your household income is somewhere below that range where this actually works, then you need to pause. Not later, not after one more showing, not after convincing yourself it'll somehow be fine. Just stop and run the real numbers honestly, without optimism, without assumptions, without pressure from anyone else. Because this isn't a small decision you can undo easily. This is something that will shape your next decade, quietly influencing every choice you make, every dollar you spend, every moment of stress you carry. You don't get rewarded for stretching too far. You don't win by proving you can survive it. The only real win is making a decision that protects your future, not just your image. The numbers don't lie, even when everything around you tries to.